Welcome to Mark's Trading, and today we are going to talk about a beginner's trading process. Now, a lot of you might, who are new, not have a process, and we have other videos as well for the intermediate term level process, and then even a more advanced process for maybe even those that want to develop a systematic, programmatic, quantitative trading strategy. But today we want to talk about, for the beginners, just a really high level, and it's just so important. I can't emphasize enough that most people do not have a process written down ahead of time. And let's really just go into a very high level of how we can kind of think of a process for someone that's really never thought of it. All right. Okay. And as we mentioned, it's, again, the most important thing you could do if you want to become a successful long-term investor or trader. It doesn't matter. Trading, investing, you need a process. All right. So for developing a process, we want a rules-based approach as much as possible. And we want to create a workflow around your rules. And again, your rules as an individual investor, you're going to have a different risk tolerance. You're going to have different objectives. Your rules might not be the same as someone else. It might be very different. You might have a much more aggressive approach to investing, where the guy next to you might not be able to sleep at night with taking too much risk. So everybody's process is really going to be defined by their own personality. But again, we need a process. Before you start trading or investing, you better have it written out. If you can create a workflow in maybe a Word document or PowerPoint, even better. If not, just write it down on a legal pad so we can have a rules-based approach. What this will do is it will help you remove emotions. If you remove emotions, it will help you to avoid mistakes. If we can remove the emotions, it's going to help us to create a repeatable process. Having a repeatable process is going to allow you, over the long period of time, to be successful. All right, so the first thing is define your strategy. Now, granted, I understand that day trading, trend following, and swing trading, and even having a long-term thematic approach to ideas. When I say thematic, maybe you believe that long-term Tesla will be a $2,000 stock or $3,000 stock because fossil fuels are going the way of the horse and buggy. But I understand that day trading or trend following or swing trading are not necessarily strategies, but more so time frames or duration of a holding period. But I want you to think in terms of these right now as a strategy. And I want you to think about how much capital you're going to deploy between some of these. Now, most of you might only be trading one strategy, but I still want you to think in terms of the holding period, because holding periods also define your risk. You're going to take a lot more risk intraday because you're not holding overnight. Trend following, you're going to have greater drawdowns, greater losses potentially, because you're holding for a longer period of time where the potential returns are much greater. So I want you to think. This is just hypothetical. Now, maybe this will fit for some of you. I like trend following to be a greater portion of my portfolio these days versus maybe 15 or 10 years ago, where predominantly a lot of my trades were intraday. But I want you to start thinking about how you, as a your own personal strategy should be defined in terms of these different approaches on duration. Next up, I want you to think about position size. And a lot of people don't really look at position size initially when you're first starting to trade. And I really don't look at I will not have a position greater than 5% regarding any strategy. It's just too big. It's too volatile. Day trading 5%. I know that it's tough. I mean, I'll take up if I'm trading the S&P, yes, it will be much greater than 5% because I'm trading the index and it's not going to have the same type of volatility as trading an individual technology stock. Granted, but I want you to think in terms of risk, because I will say eventually you will blow up and lose all your money if you start putting 100% of your money into a day trading idea. You will not last in this game. So whatever you do, before you start trading, define how much into a single idea. And I will also say this, don't add to positions, especially if they start trending down. As a trend follower, I will add to a position if it starts to increase in momentum and add, but that's for a later video. So the number one rule for new traders is don't add to losing positions. So again, think about what position size you're willing to take, and that is one of the first steps in terms of defining your risk. All right, number 4, define your risk by the loss you're willing to incur. So let's start with day trading. Maybe the max downside in an intraday you're looking to take is 3%. It's up to you. There's no answer. Maybe it's 2%. Maybe it's 5%. But whatever it is, I'm going to tell you right now, stick to it. If you start becoming subjective and changing your rules, you will lose. So whatever it is, cut it. Cut that loss exactly what your plan is telling you. So this is just hypothetical. This is kind of roughly how I view my trades. 3% loss for day trading, 5% for a swing trade. Trend following, I'll take a 10% loss because I'm trying to go for a much greater gain. The swing trader's trade is a little bit bigger than my day trading because I'm looking for double the gain in my swing trade. And then my thematic trade, I'll take a 20% loss because what I'm trying to do is pretty much double. And the thematic trade could last a year or two. So it's very different. Some of you might not even put on a fundamental type of trade. But again, this is a way to start defining your game plan and creating a process. Okay, so now know your inputs. We can't define a workflow until we define what your input is. Okay, so your inputs are your buys and your sells. And this is, we're not going to talk about signals here or buys, but this is a 30,000 foot view look at what maybe the inputs would look like. Okay, so we got your buys and your sells. Okay, so if I am doing a day trade, my input here is a 5-minute chart on a breakout. We'll talk about breakouts on a 5 or a 15-minute chart later on. But day trade, I'm going to stick constantly to that one buy buy on a day trade with that signal, and it's going to be a 15-minute breakout. My sell, if it moves below on a 5-minute ATR, I sell it. On a swing trade, it might be a 1-hour breakout on a 1-hour chart. Then I might sell it on a little bit of a shorter duration on a 30-minute chart if it moves below its ATR. Now, if you're not familiar with the ATR and the breakout and all this other stuff, that's not important right now. We'll talk about signals later. What's important here is we're defining the process. Then, for our trend following, we might look at a daily breakout, and we will then sell it if it breaks below its 1 hour. It will be a shorter time frame, so we could not lose as much. So that potentially, on a high level, hypothetical, these are our inputs for the buys and sells. Now what we want to do is put it all together in a workflow. So what are our catalysts? Is it fundamental? Is it event driven? Is it technical? Is it a fundamental reason because the company was more profitable and has greater earnings per share this quarter, or was there a new CEO that just did a restructuring. Maybe that's more event driven. Maybe there's a new CEO. Maybe there was an upgrade or downgrade, or technical that we kind of just showed in the previous slide. So A, have your catalyst ready. Then we want to define the strategy. For this document, we're talking about strategy in more terms of the duration. So is it a swing trade, is it day trade, or is it trend following? Then, prior to even putting the trade on, know your strategy in terms of how you're going to exit. Okay, so each strategy we're going to have a different exit, as we mentioned prior. The shorter the time frame, the shorter the exits. Okay, because we're looking to have the risk-reward ratio will be slightly different. Then lastly, what I would say you should do is you should really list your buys in terms of an A, B, C, D type of structure. A being your best idea, B being not as good as A, and then C being kind of in the middle of your ideas. And what this is going to do is it's going to help you stop trading trades that you shouldn't be putting on in the first place. And it will help you from over trading. And eventually, you're only going to be able to develop this A, B, D, C scoring methodology as you just get a little more experience under your belt. So it's going to take some time, but again, right now all we want to do is we want to create a workflow around the process, what is best for you. And this is really just the best way to look at it for a beginner's guide. Again, we'll have other processes for the intermediate and the more advanced, but I think this is really extremely important. More important than anything else is defining your own process. All right, so if you want, you could contact us, and we look forward to seeing you on our other videos.